Hello everyone, welcome back to Indemi Student Channel. In this video, I would like to talk about a bit more complex topic, which discuss about dollar cost averaging and lump sum strategy, which has been used by the investors. We can say that the way the investors spend or invest their money into stock. But before that, don't forget to subscribe to this channel, give the like to this video, and do not forget to comment below. Before we do investing, we have to know what is our financial goals from doing investment. These four elements are very common why people start investing. This one. I'm gonna use pen or what do I have to say? Laser point or something so you can easily recognize which element I explain. People want to increase income, right? Why? Because they have much needs and wants to be recovered. And also they have financial expense, whether for themselves or for their family as well. For example, they need to pay credit installment of purchasing car monthly. They want to increase their saving as well for their retirement, for example. And another reason is to fight for inflation. Why? Because the returns of saving money in just a normal bank are below the inflation rate. So now, let's jump to dollar cost averaging first. This is the investment strategy that has been used by the investors, in which they divide up the total amount to be invested across periodic purchases. The goal is very simple: to reduce the impact of market volatility on the overall purchases. This is also a good way for the investors, especially for the beginner, to build their saving and wealth for a long period. This is also a good method for the investors to neutralize a short-term volatility in the equity market. To make it easier, I'll provide you the graph that shows the dollar cost averaging as an example. As we can see here, this is the graph which contains of price and time. And this graph has two types of lines, the red lines and the green lines. The red lines indicate that the price of the share goes down, this one, whereas the green line shows that the price of the shares goes up, means that the market rises up for a specific period, this one. So this graph can also describe that the market situation in equity market. As we can see here, this graph goes down and goes up. In this market situation, no one or even the professionals can know or guess maybe how the market situation is gonna be. Okay, I will give the example, a case to make it easier. So there is a business student that has graduated from the top university named Joe. Oh, this one. And he works in multinational company as a business consultant and gets salary $2,000 per month. To build saving and wealth for the future, he decides to invest their money into stock by divides up the total amount to be invested, $1,000. This one. We can see here the data. The data consists of price per shares and the unit of the shares and the cost that Joe invests into stocks. By using dollar cost averaging, the investors can forget how to time by purchase the stock. Means that it doesn't matter for the investors whether the price of the shares is high or even low. They just spend or invest their money into stock without making the market situation into a big deal. So from the data, we can know that the price of the shares is vary. We can see here in the 1st January, the price of the shares is $20. This one. And it goes down until March and goes up again in April, right? And when you buy a stock in the market, it depends on the price of the shares. When the price is low, then you will get more units of the shares. This one, for example, right? $10, and you will get 100 units of shares. But when the price is high or even expensive, you will get lower unit of shares. This one, for example, $20, and you will just get 50 unit of shares. So for the investors who are stick in dollar cost averaging principle, they will forget time to purchase the stocks in the market. It doesn't matter for them whether the market volatility is all-time high or even low in the sets of market situations in equity market. Right. This is another example. With the cost of $1,000, the investor can get 50 units of shares. This one, you get 50 units of shares. Why? Because it just multiplied from the price of the shares of $20 and 50 units of shares. And at the same time, with the same cost to be invested, the investors can get even 2 times more unit of shares by 100 units when the price of the shares is $10. This one, just with the same amount, right? So, like I said before, the investors remain investing their money into stocks. It doesn't matter for the investors how much unit of shares they get or how expensive they invest their money into stocks. So now, let's move to lump sum strategy. It is the opposite of dollar cost averaging strategy. Lump sum strategy can be defined as a complete sum of money. Means that the investors invest a lot amount in one time. The investor is making contribution by investing their money into stocks, usually in the beginning of the year, rather than contributing by investing their money per month or even throughout a year. Lump sum strategy requires the investors a high level of tolerance, and it is also taking a gamble. For example, when you want to invest your money and let's say you have $20,000, this strategy would tell you to dump all of your money into your investment at a one time. And then, after that, you will run your risk with this amount of $20,000 into a stock market. For example, as what happened last year in March due to the pandemic COVID-19, maybe some of the investors will generate loss. When you have luck, you will generate much profit. It can go upwards. Hence, it's taking gamble. I also provide this one. I also provide the graph that compares between dollar cost averaging and lump sum strategy. As we can see here, the graph describes that the market situation is in a good condition. To make it easier, or we can say that the market volatility is all-time high. Why? Because the graph is always rising up. I will give you example to make it easier. There are two boys named Joe and Peter. Joe is a DCS investor and Peter is lump sums investor. Wait, this one. This is Joe. The blue is Joe. And the yellow one as a lump sum investor is Peter. right? They decided to invest their amount of money of $50,000. 50,000, sorry. Oh, it's too bad. $50,000. So means that Joe has $50,000 as well as Peter. Joe, as a DCA investor, he divides the total amount of $50,000 into a small amount per month, and he remains spending their money consistently in a year. On another side, Peter, as a lump sum investor, this strategy would tell him that Peter to dump all of the $50,000 at the beginning of the year. Peter as lump sum strategy, I mean, Peter as lump sums investor came out on the top in each time of period. Why? Because the market rises over time. So that's why the DCS investor or Joe often bought at the higher average prices. To conclude all of I have explained before, there is also a very common question. Which better between dollar cost averaging and lump sum strategy? To answer this question, the investor should know the level of tolerance they have. For example, when the investor is too nervous to invest their money into large amount, dollar cost averaging is fit for them. Dollar cost averaging investors remain investing their money per month or even per week and forget time when they have to purchase the stocks or the price of the shares and the unit of the shares they will obtain. Whereas when the investor have much experiences and they are not too nervous, the lump sum strategy is good for them. But the lump sums investors should have a great amount of money because they invest their money normally at the beginning of the year. They dump all of the money into their investment and waiting the money jumps into the market volatility. The investors should know the world situation and of course the equity market. For example, we are facing the COVID-19 pandemic right now. All of the businesses over the world is facing the financial issues. That's why it would be better for the investors to stick with dollar cost averaging principle in order to avoid a great amount of loss. Let's say when they invest their money with lump sum strategy in this pandemic, it is too risky. The investor can face a lot of loss just in a specific time. Okay, to review this lecture, I want to give you some questions. Feel free to pause the video and try to answer these questions. So, that's all of the explanation from me. I hope you can enjoy the video. I hope you can understand what I have explained before. I'm so sorry if there is mistakes, grammar error, or bad pronouns. Just comment below what can be improved from this channel. And thank you for watching.